So the U.S. Federal Reserve has decided to keep its interest rates steady, noting uncertain impacts from the war in the Middle East. For more on this, we're joined today by Professor Kim Yong-Jin at Sogang Business School. Professor Kim, thanks for coming on today.
Good morning.
So how have the Middle East crisis and the surge in oil prices affected the central bank's decision?
Yeah, the Federal Reserve decision to keep interest rate steady at 3.5 to 3.75 was heavily influenced by a tug of war between rising energy cost and softening job market. The Middle East crisis and the following surge in oil prices toward $100 per barrel, in addition to high tariff, act as a direct tax on consumers. The Fed is concerned that higher energy costs will seep into the prices of other goods and services, stalling progress toward their 2% inflation target. Moreover, Fed officials look to fear if the oil price stays high, the business and consumers will start expecting long-term inflation, leading to a wage price spiral that is much harder to break. Basically, the Fed chose to hold rates steady rather than cut them. They wanted to ensure that oil spike, doesn't trigger a broader inflationary wave, especially when the Middle East conflict is creating extreme uncertainty. The Fed, typically avoid, making a drastic policy shift like cutting rate when geopolitical shock could suddenly escalate or de-escalate.
Right, and the Fed is still expecting to cut rates once this year, despite spiking oil prices. And it also released a summary of economic projections, which showed higher inflation projections for the year. What do you make of the latest projections?
Yeah, the Fed decision to keep one rate cut on the table while simultaneously raising inflation forecast looked like a contradiction. But it reveals that the Fed is trying to perform a highly balancing act. The SEP, summary of economic projections, indicate that even though the median dots still point to one cut, the distribution of the dots shifted significantly. In previous report, many officials saw 2 or 3 cuts. Now almost everyone has moved into one cut or 0 cut camp. By keeping one cut in the forecast, the Fed essentially saying that we aren't giving up on easing yet, but we are pushing the start date as far back as possible, like September or December. It is noted in the SEP is that the Fed accepted higher inflation for now by raising the core PCE inflation forecast to 2.7%, up from 2.5%. It shows the Fed acknowledges that the Middle East crisis and oil spike aren't just temporary blips. They are sticky pressures. The question is why did the Fed still primes a cut if inflation is rising? The Fed saw the 92,000 job losses in February. They are worried that if they stay at 3.5 to 3.75% for long, the economy won't just slow down, it will crash. So I believe that one cut isn't meant to stimulate the economy, but it's meant to move the rate slightly closer to the neutral so they don't accidentally trigger a deep recession.
Right, and South Korea will also decide on its own rates next month. That's on April 10th. How might the Fed's move affect the Bank of Korea's decision?
Well, that's tough, right? I believe that the Fed decision to keep the rate, unchanged significantly narrows the Bank of Korea's, maneuverability for its own April 10 meeting. The BOK now faces a triple high crisis: high oil prices, a high exchange rate, and a high interest rate that likely mandate a continued rate hold at 2.5%, with the Fed holding at 3.5, 3.75%, and the BOK at 2.5%. The 1% to 1.25 percentage point gap persists. A cut rate by BOK now would widen this spread further. risking massive foreign capital outflows when Korean won has recently approached the psychologically critical 1,500 won per dollar level. Any BOK easing would, put further downward pressure on the won, or making import, including energy, even more expensive. South Korea relies on the Middle East for 7% of its oil, cutting rate, while, energy-driven inflation is accelerating, could cause headline inflation to rebound sharply above, the 2% target. In sum, Fed hawkish, pose effectively locked the BOK into a pause, as well as Korea cannot afford a weaker currency while fighting an energy shock.
Right, like you just mentioned, the Korean won moved past the 1,500 Korean won level against the US dollar this week, and this marked the first time it's broken that level in daytime trading in 17 years. So has the 1,500 won exchange rate become the new normal now?
Well, I don't think so. But although, the 1,501 mark, has been breached in daytime trading for the first time since the 2009 global financial crisis, I view it as a temporary spike driven by extreme geopolitical stress rather than a new normal for a stable economy. The primary trigger are the effectively closed Strait of Hormuz and global oil prices surging past $100 per barrel, right? And most analysts suggest, 1,501 level is not yet entrenched, but it could become so under specific conditions. Let's say if oil prices stays above $100, and the conflict becomes a protracted war, the 1,501 per dollar could become a more permanent feature of the 2026 economy. If this level were to persist, it would likely lead to sharp rises in gasoline and raw material cost, weakening domestic consumption, and potentially causing, South Korea to miss its 2% growth target for the year.
Right, and before I let you go, more broadly, the Iran war has already, heavily impacted the global economy, like we just discussed, driving up oil prices, and this led to a spike in the cost of living and airline fares. So could the conflict trigger a global recession?
Well, the Iran conflict, has already posed a serious and growing threat to the global economy. A prolonged war, which causes a sustained disruption to critical energy and trade routes, could trigger a global recession if oil prices stays over $100 or climbs toward 140 to 150. It would likely push more major economies into recession. The effective closure of the Strait of Hormuz, by Iran, has already forced the ships to take longer, more expensive route around the Cape of Good Hope, and doubling, some shipping cost. Moreover, considering the fact that the Middle East is a major producer of fertilizers and critical materials like helium, which is essential for semiconductors, disruptions in this area could lead to long-term increases in global food prices and high-tech manufacturing cost. So the war that lasts beyond 3 months significantly increases the possibility of a guaranteed global recession.
I see. I guess we'll have to see how that goes. All right, Professor Kim, thank you so much for your time and insight today. We appreciate it.
Thanks for having me.